Now, let's get down to the real nuts and bolts of small business valuation. We could do what most people do and stand in front of a whiteboard and start listing the various valuation methods and explain them one by one, but this is so boring. It's confusing and it doesn't get to the crux of what really drives value in a business. So we teach this in a different way to most people. We've distilled this huge area down to the core principles. We're going to show you a system for valuing small businesses, with one underlying principle tying together the three core valuation methods. This way you'll learn the underlying concepts and really understand what gives a business its value. Then you'll understand all of the other methods, which are just variations of these core principles. So, what is a business worth? What is anything worth? Now, we're not talking about the price that would mean the buyer is getting a bargain. We're not talking about overpaying. I mean the actual value. Somewhere in between a bargain and overpaying is the actual worth, the intrinsic value. And this worth, this value, when it comes down to it, has to be exactly equal to the total value of the benefits that will be derived from it in future. So with a business, this means its value is exactly equal to the sum of its future cash flows. That's it. That's the intrinsic value. The right price to pay for a business today is equal to the sum of all of its future profits and losses added together to infinity and converted back into today's money. As long as this number is greater than the value of the net assets, then this will be the value of the company. Otherwise, the value will simply be the value of the net assets, of course. Basically, no seller would sell for anything less than this. We'll come back to this case at the end of the video. For all other businesses, the value would be the sum of its future cash flows converted into today's money. If someone was to pay exactly this price today, it would be an exactly fair deal, because that person would receive back exactly the same amount of value from this business in total. This principle holds for businesses of all sizes and all industries. Warren Buffett described it eloquently in his 1989 letter to shareholders. He said, with perfect foresight, this number can be calculated by taking all future cash flows of a business, in and out, and discounting them at the prevailing interest rates. So valued, all businesses, from manufacturers of buggy whips to operators of cellular phones, become economic equals. This is the foundation of business valuation, and it's so powerful that it reduces all businesses to being on an equal footing. Whether the business is making obsolete products like buggy whips, or high-tech products, or selling services or advertising, or just being an influencer on Instagram, the principle is the same. The value of the business is the sum of its future profits and losses in today's money. A quick note about today's money. Basically, it's worth more to you to receive a certain amount of money, say £100 or $100 in this example, than to receive the same amount of money in the future, because you could earn interest on the money in the meantime. So if you were to wait and receive that same $100 in a year's time, it would be worth less to you in today's dollars. This is the principle of the time value of money. To allow for this, you can discount future earnings by an interest rate to convert them back to their value in today's money. So a business is worth the sum of its future cash flows discounted back into today's money. You might say every year's profits added together from now to eternity. That would be a huge amount. It might even be an infinite amount. And it would if the business was profitable every year. But we're talking about the future. We don't actually know what the future cash flows will be. It might make great profits next year, and then even better for a couple of years, then start making losses and go bankrupt. It might go bankrupt next year. We just don't know. So what we're talking about here is confidence. How much confidence do we have that a business will continue to be profitable? And for how long into the future? How much profit will it make each year? And how confident can we be in our estimates of that? Predicting the future is hard. To estimate future profitability, we can use current profitability as a guide, and this is what we do, but it's only a guide. As we look further and further into the future, it's progressively more difficult to predict whether the business will be making a profit, at what level, or even if the business will continue to exist at all. So how do you actually do this? How do you actually add up all of the future cash flows of a business when you don't actually know what those cash flows will be? Assumptions. You make assumptions for everything and you put them in a spreadsheet. Using past profits as a guide, you can make assumptions regarding the future profits and how long they'll continue for, whether they're likely to increase or decrease over time, and so on. Into your spreadsheet go assumptions for business growth rates, industry growth rates, competition, market trends, and everything else you can think of. If you want to get really detailed, you can make assumptions for national and global economic variables, right down to the likelihood of climate change or war affecting the business environment, and the impact that each of these variables would have on the future profits and losses. Each of these variables would have a value in your spreadsheet and an impact on the cash flows that you're forecasting for each year in the future. Each year's total net cash flow would then be discounted at an interest rate that we would choose to allow for the time value of money and the specific risks affecting this business. Then we would add these up and voila, we'd have our exact valuation. This is called the discounted cash flow method, and it's exactly what analysts do when they work on large-scale M&A deals for large private or public companies. It's the classic valuation method, but for all of its strengths, it's only as accurate as the assumptions it's built on. To illustrate this, let's use an example where we don't have to make any assumptions, because we have perfect knowledge. The perfect business would be a goose that literally lays golden eggs of a predictable size in a predictable frequency. Let's say we know for certain that this is the only goose of its type and that the price of gold is fixed, so we always know what an ounce of gold will be worth. We also know how old the goose is and how long it has left in its productive life. We're 100% certain that the magic that affects this goose allows it to lay golden eggs will continue, and that this magic applies only to this particular goose, so there will be no new competition arising. We're also 100% confident that political and economic developments will not cause a change in the global gold pricing system, and it will stay at a fixed price. The costs of food, shelter and security for the goose are known, and we're 100% confident that these costs will rise at exactly the rate of inflation, which we're also 100% certain of. With this knowledge, we could simply calculate how much gold the goose will produce until the end of its productive life, and the value of all that gold. We know the cost of keeping the goose each year, so we can work out the profits from the goose for each year with 100% confidence. After adding up the total value of the net earnings for each year until the end of its productive life, and discounting back to today's dollars, we would have the value of the goose. In this scenario, the goose isn't just worth a fortune, so to speak. Using the discounted cash flow method, we can literally calculate exactly how much the goose is worth. It's easy in this scenario. With a real business, on the other hand, we don't have anywhere near the same level of certainty. We don't know how much revenue it will make each year into the future, or what its costs will be. We don't know if there will continue to be a market for its products or services in future, or if it will continue to grow or shrink. We don't know if competitors will enter the market, or how many, or how successful they'll be. We don't know if broader economic issues like recessions will affect the business in future, or other issues like political change or war or environmental changes. We can't predict for certain how technology will affect the market. Even within the business, there are lots of variables relating to key staff, from performance to accidents to the risk of bizarre harassment scandals. All companies have litigation risk. Some have foreign exchange risk. There are thousands upon thousands of things that will affect the profitability of the company in future. So the reality is, we can't be very confident in anything. But this is the nature of business valuation. Now, we can build our discounted cash flow spreadsheet and start making assumptions for all of these thousands of variables, but the valuation figure will only be as accurate as the assumptions it's based on. There is another way. We mentioned confidence earlier. Our confidence in a business forms the basis of all the variables in our spreadsheet. For a business that we have more confidence in, the numbers in the spreadsheet will be higher. Each risk will be expected to have less of an impact because we're confident in the company's ability to withstand it. Each opportunity will be more effectively exploited, we assume, because of our confidence in the business. So this translates into a higher valuation figure at the bottom of the spreadsheet. Now, once a valuation has been calculated, an investor will always want to know the payback period on the investment. In other words, at this price, how many years will it take for him or her to recoup the investment? Based on the annual current earnings of the business, how long will it take for the purchase price of the business to be repaid? If we're very confident in a business, we believe that it will exist and make profits for a long time. So an investor would be okay with a long payback period of many years. In other words, the valuation of the business will be many times its current annual earnings. For a business that we're not very confident in, the payback period will have to be shorter. In other words, the valuation will be lower relative to its current annual earnings. An investor would want to receive their money back in a shorter time frame from an investment like that. The classic way to think about this concept is with publicly traded companies. For any company listed on the stock exchange, the value of the company is known at any point in time. It's called its market cap. It's just a number of outstanding shares times the share price. The market takes into account every possible variable about the company's future prospects and determines the value at any point in time. All of the variables that would go into a discounted cash flow spreadsheet and more, theoretically, literally everything that can affect the business in future, are taken into account by the market, and the valuation of the company is produced live. Since the value of the company is known, and its profits have to be published in detail, so these are known, the price-earnings ratio, or PE ratio, can easily be calculated. It's the ratio of the company's price, or value, to its annual earnings. It's exactly the same as the payback period. It shows how many years it would take an investor to recoup his investment at the current annual earnings. The PE ratio is also called the PE multiple. Now, let's say we're trying to value a company where we don't know the valuation already. Instead of using the discounted cash flow method and then deriving the payback period from this, what if we did it in reverse? What if we already knew the payback period that investors would demand on a business like this? In other words, we already knew the PE multiple. Then we could simply multiply 1 year's earnings by that figure and we would have the value of the company. This is the principle of the PE multiple method of valuing small businesses. It makes sense, right? Instead of all of the individual assumptions we'd have to make with the discounted cash flow method, we can just make one assumption that includes everything by choosing the PE multiple. And the best thing is, for small businesses, this method is no less accurate. Both methods rely on assumptions. Both are subject to uncertainty, and both are very well accepted valuation methods. And for small businesses, the PE multiple method is much more appropriate. In fact, the PE multiple method is the most important valuation tool for small businesses. With this method, the crux is determining the multiple, of course. We could build a spreadsheet of variables for this, but we wouldn't be saving any time. Instead, what investors typically do is look at the PE multiples of other similar businesses, and they use those as their guide. Similar companies should have similar valuations. In particular, they should have similar PE multiples or payback periods. If you think about it, two extremely similar businesses would be extremely similar investment opportunities, and they would be expected to have extremely similar payback periods. So when choosing a multiple, it's completely valid to simply look at the multiples of other similar businesses and use these as a guide. For example, if you know that businesses similar to yours sold for between 2 and 3.5 times their net profits, this would give you a good indication that your business would be worth a multiple somewhere within this range. If businesses similar to yours sold for between 5 and 6 times their net profits, it's likely that yours would sell for a similar multiple. So what defines similarity in a business and the right PE multiple? Well, firstly, there are some basic principles, which we'll discuss in a minute. Then there's comparable data, literally available data on the sale prices of similar businesses. And finally, there can be industry-specific rules of thumb. So in terms of basic principles, the most important one is size. The size of a company, its turnover, has the biggest impact on its multiple. Simply put, larger companies are less likely to fail. So if we were to forecast their earnings into the future, we would have more confidence that there would be a future beyond the next few years. We generally have more confidence in everything with bigger companies, so we'd be happy to invest with a longer payback period. So publicly listed companies may trade at 10 to 30 times multiples of their net profits, or even higher. Large private companies sell for 6 to 8 times their net profits, and so on down the line, with smaller companies changing hands for 3 or 4 times net profits, and the smallest often selling for closer to 1 multiple of their net profits. Industry has a big impact on the choice of multiple too, especially the specific subsector that the business is in. Some sectors are viewed as being more risky than others, and some are viewed as having more growth potential. Tech stocks trade at higher multiples, higher PE multiples than car companies, reflecting their higher anticipated growth potential. For smaller businesses, the same principle applies, although to a lesser degree. There isn't anywhere near as much variation based on industry for small companies as there is for large ones. All of the other characteristics of the business, how stable it is, whether there are long-term contracts in place, whether it's under management or very reliant on its owner, everything. All of these factors count, but they're secondary. These factors determine how attractive an investment the company is and where it sits within the range of PE multiples. These factors are very important, and for small businesses, they often determine whether or not a company will sell at all. But they are still not as important as the industry and especially the size in determining the PE multiple. Interestingly, location is not very important at all. Even between US states, for example, a business in Florida and a very similar business of the same size in Nebraska will trade for the same multiple. The real estate is different, of course, but the business itself will be relatively unaffected by the location. So we've covered the basic principles. The second source is comparable data, comparable sales data in particular. The first type of this will obviously be your own industry knowledge. If you have experience in the industry, you will have heard of someone's business selling recently, and you might know some of the details of the business, so you can compare it to yours and gauge how similar it is, and get an idea of the PE multiple and price that your business might sell for. But be very careful with this. The bigger the data set is, the more reliable it is. So if you only know of a few recent sales, then the data set isn't really big enough to give you a reliable indication. The second type is published databases of comparable sales. We're going to discuss these in a lot of detail in our next video. There are some great free sources of comparable sales data that specifically cover small businesses, which can be very useful. Every data source has its own issues, as we'll discuss in the next video, but these sources can at least be a useful guide. Finally, there are rules of thumb that apply to certain industries. Interestingly, these are often hybrids of multiples and asset valuation methods. And sometimes they're based on sales rather than net earnings. For example, a rule of thumb in an industry might be 0.5 times sales plus inventory. In this rule of thumb, they're telling you what multiplier to use, 0.5, and in this case, it's a multiple of the total sales of the business plus a component of its assets. This rule is an example of a rule of thumb used in an industry like liquor stores in the United States. The multiple in that case can vary from 0.4 to 0.5. We're going to discuss rules of thumb in a lot more detail in video 4 in this series, so we won't dwell on it here. Also, bear in mind that even when there is an established rule of thumb in place, people will still want to come back to the traditional PE multiple method as a cross-check. They still want to bring the valuation back to a multiple of its earnings. Speaking of earnings, there's one final point to mention. With the PE multiple method, we always talk about a multiple of earnings, but it's important to define exactly what that means in each case. With the public company example, the term earnings is always understood to mean exactly the same thing, but for small companies it can vary. Normally, we're referring to the net pre-tax profit of the company, but it's quite common for people to use a multiple of a different version of earnings. For example, we might refer to a multiple of EBITDA, or a multiple of the seller's discretionary earnings. In the first video in this series, we explained the differences between all of these different profit terms and why this is important. You can compare the multiple of EBITDA between two companies, or the multiple of SDE between two companies, but you can't mix and match. When you're talking about multiples with small businesses, you have to specify what type of earnings you're referring to. For example, someone might say a business sold with a 3 times multiple of its SDE, or they might say a 4.2 multiple of its EBITDA, or a 5.1 times multiple of its net profit. Without knowing what it's a multiple of, you wouldn't be able to calculate the valuation. Furthermore, sometimes people even talk about a multiple of sales, like in the last example. In other words, a multiple of their top-line revenue instead of a multiple of their net profits. This will obviously give you a drastically different number. So while the valuation is the earnings multiplied by the multiple, in order to compare apples with apples, you have to define exactly what type of earnings you're referring to. So in summary, the value of a business is the sum of its future cash flows in today's money. This is equivalent to 1 year's earnings of the business multiplied by the expected payback period on the investment. In other words, the PE multiple. Instead of making many assumptions to calculate the future cash flows, we can incorporate all of these assumptions into one estimate of the PE multiple and calculate the value from this. The PE multiple represents the risk profile of a business based on other similar businesses. It is the most important method for valuing small businesses. Even if a different method is used, or if a valuation is agreed on by some random negotiation, people will always want to know what multiple of earnings the figure represents. Now, we mentioned at the start of this video that a business is worth the sum of its future cash flows as long as this value is greater than the value of the net assets. So what happens when this isn't true? What happens when the net assets are worth more than the sum of the future cash flows? This can happen for a number of reasons. A business might be unprofitable, for one thing, Or sometimes the entire profit of the business might be related to its owner, who won't be staying with the business, so the future profits will be zero without him or her. Or it might be that the business is making a profit, but its asset value is higher. Some companies are very capital intensive, like manufacturers and trucking companies, and if profits are marginal, then the assets they've built up over the years will substantially outweigh the value of the future profits. A business might be extremely small, and even though it's making a profit, when a realistic multiple is applied, accounting for risk, the total valuation is quite low, lower than the value of the assets. With small restaurants and takeaways, this is often the case. The future cash flows are worth less than the value of the kitchen equipment, the furniture, fixtures and fittings, so the owner sells these instead of the goodwill of the business. Freehold property is another example, but this is slightly different because the business can be separated from the asset. The property can be sold and the business will continue. We'll deal with all of these examples in video 5, but the principle holds. If the sum of the future cash flows is less than the value of the net assets, then the net asset value will determine the valuation. These cases are really asset sales, so an asset valuation is the appropriate method. Now, let's summarize everything we've covered. The value of a business is the sum of its future cash flows. We can calculate this by making thousands of assumptions and adding up each year's cash flows into the future using the discounted cash flow method. Or we can make one assumption about the payback period required by an investor based on other similar businesses using the PE multiple method. For businesses where the net assets are worth more than the sum of the future cash flows, then an asset valuation method is more appropriate. These three methods are the core of business valuation, and all of the other methods are secondary to them. In fact, they're all just variations of these core principles. For the remaining videos in this series, we'll focus on the PE multiple method and the asset valuations, since these are the two that are most applicable to small businesses.